Welcome to Investors Hangout. This fortnightly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Today we are here to discuss what the Union Budget 2020-21 means for investors, along with an actionable plan. And to do that, with me today is Dhirendra Kumar, CEO Value Research. Welcome, Dhirendra.
Thank you, Ruchira.
So first up, let's start with the overall direction of the Union Budget. What's your opinion about it?
I would say, there has been plenty of opinion around the budget. So my opinion is not very material, but I'll just summarize what the budget is. One is that, for the first time, our budget is all about how to spend. And because there is a context, because there is a crisis, and it's a global crisis, all other economies have been spending their way out of this difficulty or trouble, because it has not just been a healthcare issue. It has become an economic issue as people, all economies coming to a standstill as a result of this pandemic. So all other economies are dealing with it in their own way, and we just didn't have the resources. And this is because of this context. It is also not possible to be in a position to tax people. So it is all based on the borrowing. So that is why for the first time, our government, this budget will have a deficit of 9.5%. It was unthinkable a year ago. If in fact our markets would have tanked, or global rating agencies would have downgraded India, if this thing would have happened a year ago, but not so now, because it's on a relative basis, it's not much. The other is that it's a very imaginative budget, because it has gone about prioritizing the spend. And it has taken, this budget has taken great responsibility on the government, because all the money will be borrowed to begin with, but then it has to be paid for. And that, it has to be paid for by selling a lot of assets, selling a lot of, low producing or low return assets, or, assets which we should have given up in the first place, or we should not have it in the first place. So when I look at, all the plan of the way assets will be liquidated, some of the assets, the way they will be monetized, I think it's quite imaginative. And also the scale of the growth of the infrastructure, the healthcare infrastructure, and good part of it is going to be capital spending. So if all of this gets implemented over the next 2 to 3 years, then it will make a visible difference in our surrounding. You will have a completely different kind of road, different kind of connectivity, and all across the country. So this is going to be, and this this government, if it is high on execution, high on efficiency of execution, then all this will translate into a very magical, complete difference to a lot of citizens.
You spoke about how it will make a complete difference to a lot of citizens. So let's move on with that only, and talk a little about how will this budget impact a common man or an investor. Can you talk about that a little bit?
The first thing that over a period of time, the most impactful thing will be that we run the risk when the government borrows and spends money. Then we run the risk of inflation or rising inflation. Prices will go up. Now we have to see what kind of impact it will have. So that is something which actually affects everyone, and it hurts the poor most. So inflation is said as a tax for the poor. So that's one. That is an imminent risk. But besides that, if you look at what has happened directly, and the most talked about thing, that people above 75 years, I think people above 75 years, they don't have to file a return. And many people actually thought that this is something which people above 75 years, they're going to be exempt from taxes. That is not the case. If you have pension income, and if you have interest income, then you have just one bank account, then you don't need to file the return. So it is a convenience, and the bank will calculate your tax, and that is it. It will deduct the tax from your bank account, and you don't have to really file a return. Then and there could be withholding tax, the tax deducted at source, which will take care of it. Then we had two tax exemptions available for buying homes that have been continued for investment. For the additional deduction available for buying a house up to 1.5 lakh. So that continues. It has been extended for 1 more year. So I would say that it's an interesting one. It's a useful extension, because a lot of people would have planned, or this budget is really emphasizing the low cost housing promotion, and in that sense, this is a very important extension. Then rest of the things, when I look at all other stuff, it is not very meaningful. It is a lot of conveniences, like bank deposits now getting insured up to from deposit credit guarantee to the tune of 5 lakh rupees. So that's that should have been there in the first place. So I would not say that there is anything substantial, but I think in terms of convenience, a lot of people are going to get, I'm just wondering that a lot of people will not require the chartered accountant as much as they required in past, because now, given your income, and if it is structured, the government knows about it, and if you're getting your money in an organized manner where your PAN card is there, then the government will be aware of all the TDS, all the payment made to you, the nature of the payment, and government is really targeting that they will be giving you a pre-filled return form, and so that I think is a great attempt, and I think it's a great attempt in a manner that few years down the line we can actually look forward to a situation where we don't have to file return, because the government knows it all the things that you have bought, all the things that you have earned, your capital gains, and now the kind of digital backbone our country has, which is quite phenomenal given the complexity of our country. We have everything getting digitized. So I think only except for land and buildings, everything is digital, and that also is digital in many states. A lot of things, everything can be digitized, and one can get a simple slip of all that you owe to the government or all that you don't owe to the government, and with great convenience. So I think it is all about conveniences this year. But Ruchira, this budget is very beneficial from another thing. Not that investors got, or individuals got any advantage or benefit, just that individuals have been saved from any taxation, because this was a great excuse for the government that we are in a tough time, and so you better pay up, and everybody was anticipating the tax rates might go up. There could be a clamping of or increasing the capital gains tax, or clamping of wealth tax, some such thing. That has not happened. So that what has not happened is a good news for investors.
The market also has reacted quite positively to the union budget, and since the markets have soared, what should be the strategy for investors? What should they be doing now?
One is that market has gone up, and market has gone up, but market went down by 7-8% before the budget. Market touched 50,000 on the Sensex, or crossed 50,000. Then it slipped. It slipped in anticipation of a very tough budget coming our way, and then it realized that okay, it's not going. It's a different kind of budget. It could be economy and business. It's a budget which will actually encourage that. It is beneficial to economy and businesses. So once this realization, seeped in, we saw the market recovering, market making a comeback, and it continued. But I don't think individuals should be making a plan based on what the budget is. Your plan, as we keep talking in Hangout, as we keep talking in all our opinions from value research, that you should have a long-term plan, and it should not depend on the union budget or any special event. Investors also have to understand that risk of not being in the market on a certain occasion. As you have seen that 5 days before the budget, the market lost 8%, and 2 days after budget, the market has gained 7%. So not being in the market for a brief period, because all the market gains, when we say this 15%, 20% annualized return over the last 10 years, 15 years, 20 years, the problem is that it does not come like a nice, the return from the market is not like that of a fixed deposit. You are not getting these returns every year. It comes in fits and bouts. These 8% gain and 8% loss came in 2-3 days. And this is how the big moves are made when you least expect it. When a lot of investors give up on the market, then markets make a comeback. When a lot of investors think that easy money can be made in the market, just invest anywhere and it's going up, that is the time when you get the nasty surprise, when markets crumble. And so look at this graph. We have looked at the cost of not being in the market for last any 5 days. the best 5 days or the worst 5 days really, you generate most of the return during the year, or it'll reduce the return substantially if you are out on those key days and you are trying to time it.
All right, now time to move on to the viewers' questions. The first one comes in from Jeetin, who asks, since the union budget proposes to spend heavily on infrastructure, will infrastructure specific funds go up in the coming years? Also, would you suggest investing in them? He's also asked for your opinion about banking sector specific funds.
Yes, I'm hopeful that some of these infrastructure companies will benefit. And infrastructure funds, we have very old infrastructure funds, and they have struggled. They were very popular at a certain point prior to 2008. They actually drove the 2008 bull run. It started with infrastructure stocks, but I think infrastructure has been a reasonably discovered sector. And a lot of companies are actually facing a problem of a different kind in terms of in a competitive market, their cost or the way they are structured. So I don't know which of these companies will do well. Then there is a problem with the infrastructure fund. Many of these infrastructure funds have very loose definition of infrastructure. Some funds have banking as part of infrastructure. Some funds have in fact many funds have such liberal definition of infrastructure that if you just drop pharma and technology from any fund, it becomes an infrastructure fund. Everything else could be part of it. So pharma, in IT and FMCG, 3 sectors excluded from any fund, and it becomes an infrastructure fund because you can justify. I was looking at this some time back, and 65% of the Sensex can be defined or can be said to be infrastructure. So infrastructure is a very loose definition. I would say that invest in a flexi cap fund. The fund manager will will try and tilt your portfolio depending on the potential, and don't try to write the infrastructure fund, because the problem of infrastructure fund has been they are out of the very promising sector. Pharma, FMCG, and IT are big drivers of any fund performance. So, and it is good to have them. So despite having good outlook for infrastructure, don't give up on the diversity. I'm very optimistic about the banking sector, and banking sector has also made a comeback, and some of the specific budget announcement is going to benefit banking sector substantially. Creating the bad bank, which will actually absorb all, which will take all the bad loans, and that will be a one-time big relief for many of the banks, and that will relieve them to start running. Also, a big banking reform has happened in recent times, but it has gone, it has not gone unnoticed. But I don't think that it has been talked about, or it got just, did not get talked about as much, simply because we were too busy with the pandemic. If you look at all the consolidation of the public sector banks, the promising banks getting consolidated, all the merger that has happened, then you have government has gone about stating that they are going to privatize, sell those 2-3 banks which they have clearly stated. They are also going to contribute to the developmental financial institution with a funding of 20,000 crore, which will end up holding assets worth 5 lakh crore. So this has been a big problem in India. These commercial banks, they borrow short term. We do our deposits, or they have current accounts, savings account balances, and they end up investing. All the corporate banks, the state banks and the ICICI Bank, they faced a problem that their investment was long term. They are doing some term lending to companies, which is for a 5-year term, 7-year term. So, and you have an asset liability mismatch. So we need, of course, I'm not sure that this idea will work, but at least it will take quite a good amount of pressure from the commercial bank. And so bad bank, commercial bank, banking reform, and the the NPA problem being marginalized or coming down gradually over the last few years is good news. So I'm very optimistic about the banking sector. But should you buy banking fund? No. If you buy any flexi cap fund, 35%, take note of it, 35% of these funds is allocated to banking stocks. So why have them?
Right, then Ravi wants to know, should one continue to invest in ULIPs as their maturity amount has been made taxable after a certain threshold?
that threshold is 2.5 lakh rupees. If your annual premium is more than 2.5 lakh rupees, then you are supposed to, it will be taxed like a mutual fund. But even mutual fund taxation is not very, painful in that sense, or not very taxing. I would say one should not be investing in ULIP. One should not look at ULIP as an investment vehicle anyway, this budget or not budget. And of course, this budget for somebody paying high premium, it has only catalyzed the whole thinking that if you are making such investment through ULIP, it may not be a very wise thing.
PVS K. Chaudhary asks, do you think the current equity market is in a bubble state? How likely is for it to burst in the near future?
I wish I knew. And I really don't know. And I will just give you the context of yes and no, possibly yes or no. If our economy and businesses make a comeback next year, also incentivized by this budget, and we are able to overcome the crisis that we are in, that economies or businesses have come to a standstill, and they're certainly beginning to start again. The airline have to achieve their capacity, or the cinema hall has to open, and we are getting back to the old days after the vaccination. So if we are able to achieve 80-90% of our activity, then the market may not be in a bubble mode, because everything will happen. The companies will make money, because the primary driver, if you look at the price earning ratio, or the how cheap or expensive a company's stock is entirely a function of the earning. If their earnings go up again, then it is not a bubble. If this economy or businesses are going to drag for 2-3 years and they are unable to make a comeback, and they're struggling, then this is a bubble. And if you think on that side, if you're pessimistic about the recovery of our economy and market, then it is a bubble and you should take your money out.
Bidhu Bhushan wants to know, would you suggest moving unused money from savings bank account to an overnight fund?
No, I don't think the differential will be anything meaningful. The liquid fund or the ultra short-term bond fund might still make sense in a manner that you want to invest for a couple of weeks, or you don't know. It could be few weeks, it could be few months. People have such goals. So in that case, ultra short-term bond fund or liquid fund can still make sense. Overnight funds do not generate anything meaningful as compared to a savings bank account. So if you are actually, if you have a bank account where you are getting 3.5% or 3%, or the savings bank account in some of the bank which is yielding 5-6% or 7%, then have it. You are making more money there.
All right, now Anand has sent in the next query, and he asks, after investing for a long-term goal, which is about 10 to 15 years away, how does one evaluate in between if the selected mutual fund schemes are doing well, and whether or not the investment strategy needs to be changed for achieving the desired goal? Is there any mechanism for it?
Yeah, there is a very simple mechanism for it. You invest in a fund for a set of reasons, and if those reasons disappear, you should change, whether it be a bunch of rating or a fund manager or the diversity or the performance or the relative performance. And I would like to plug one of our products here. If you don't want to do the hard work, then subscribe to Value Research Premium account. Here you have a set of analyst choice. If you were making if you're choosing funds depending on your need from the universe of the analyst choice, where our analysts are analyzing funds, talking to the fund manager, making a measured judgment about the future potential of these funds, and they're keeping an eye on that. So if you want value research analysts, and quite a few of them, to do the heavy lifting of keeping an eye on the fund which they are recommending, and also telling you when it has to be sold, when you should not have them, then subscribe to that, and it will be useful, and it will also be visible in your portfolio tracker. But in a simple way, you can look at the numbers. You can also do it reasonably well. Disappearance of the reason why you chose a fund should be the reason.
Dinesh Shivale wants to know, when and how should one exit an equity investment? He's asked for suggestions for both scenarios, profit booking and using stop loss methodology to reduce losses.
I really suggest that one once somebody is investing for the long term, this profit booking and stop loss, these expressions are meant for the traders, the people who come and trade or buy, invest for few days, or maybe sometimes during the day, or maybe few days, or maybe few weeks, or maybe futures and options, the derivatives, and they are due for expiry on a certain day. So because all derivative contracts expire in a month's time, so it is meant for those people, because those investors, they have 100 rupees and they do a transaction of 1,000 rupees. They have borrowed 900 rupees effectively, and they're taking a position on 900 rupees. And then that money goes up or down, or little bit of change, assuming that the stock price goes from 100 to 90. In that case, this person, this investor, will actually lose all his money, because that's the problem of leverage. And there is an upside too. If the stock goes up by 10%, it will multiply by 10 times. So he'll be able to double his money. So in that sense, it is quite beneficial, and it could be quite injurious. And for them, this profit booking and stop loss works. Otherwise, for the kind of investors who come to value research online, or the kind of investors whom I would like to, the kind of investors whom I would like to invite at Value Research Online, they should be investing in good funds for a long time, and they should be doing their SIP. And as they get closer to their goal, they should start disinvesting. In between, if you have invested in a fund and that fund is no longer good, then you should make a change, and you should do an annual review of your investments, and that's about it. That will largely take care of your long-term investment needs, or that is what long-term investment need of most investors is.
Pranay Kumar has been choosing best rated funds according to goals and asset allocation. However, he says that value research rating of the selected fund soon changes and often falls after investing. Why does that happen, and what should he do is what he wants to know.
One is that value research rating is not that volatile. It changes, and in fact, the value of the rating is that changes. In fact, if you think that we have given a 5-star or a 4-star rating to a fund, or have got a 5-star or 4-star rating, and it will never change, even though it has stopped doing well, then I think it will be a great disservice to you. Let me just explain you how this rating works. Rating is a quantitative measurement of a composite measure of risk and return, and we follow a mathematical model. That mathematical model implemented on the historic valuation or price or NAV of the fund drives this rating. So it is not that we sit and assign rating to funds. No, there is a formula, and our computer does that. Of course, we have devised that formula. Value research, analyst choice is something which you can actually come and complain about, that we recommended a fund and have we changed our mind very quickly. And there, a value research analyst, if he changes his mind about a fund, then he will also give you an explanation why is he changing his mind, what has led to this change, and hopefully it will be a convincing reason. So rating could be one starting point, and I think change in rating is a good pointer. You should take a look at rating as a great pointer, that it will force you to think that what has changed in the fund, because all market linked investment, you can't invest and sleep over it. Investments change, markets change, fund managers change, and like that is why your fund should also change when something changed for the worse.
Today's last question has been sent in by Randam, and he wants to know what asset allocation would you suggest for a 45-year-old with moderate risk appetite?
No, this is not enough input to actually decide on a asset allocation. Two more factors actually decide, is a crucial input to deciding on an asset allocation. One is that what has been your experience with the market? Have you been an old-time investor? You understand. Do you get very upset with a 10% decline in the stock market? And so your equity fund as well, sometimes in a month's time or in few weeks' time, then you are a different kind of investor. If you get very upset, you need to be treating, you should look at things differently. If you have invested for the last 10 years, if you have seen 2008, and you understand that it is like this only, and yet it does well, it has been profitable, then your risk tolerance is different, because Risk tolerance is nothing but how how will you absorb what will happen to your money in a brief period of time. And the other thing is how far you are from your objective. So if this is meant for your retirement, if you're likely to need this money after 15 years when you retire, then I think you have time on your side. And then I would say that you can have most people in your tax bracket, if they are unlikely to need this money for next 15 years, you have a little bit of experience, then I would say that have 75% into equity, 25% into debt, and rebalance it periodically, maybe 6 months, 1 year. If you are if you don't have much of an experience, then I would say have 40% into equity, 60% into debt, because then you will not be unnerved by the fall in the market. And because to benefit from the market you have to stay there, and to stay there you have to deal with it in a manner so that you don't run away, because market is a very scary place. So I have two suggestions, but 40-60 or 75-25, depending on your experience.
Well, that's it for now. Thank you, Dhirendra.
Thank you.
Thank you to all our viewers. Do keep sending us your questions and keep watching this space for more information. Bye for now.